earning per shares and dividend yields are one of the best pointers that every institutional investors check before investing in any stock. Now, we on Clockwise, we've done this for you. We've looked at these particular stocks. They are oil stocks from the downstream sector. Now, we've monitored their earning per share. We've also monitored their dividend yield, and we can tell you they'll be making millionaires in the coming days. Now, if you follow us to the end of today's event, you are going to know these stocks. My name is Providence. Welcome to Clockwise. Like I do it often, my guest is here. And with a resounding virtual round of applause, welcome, Mr. Kandem. Welcome to Clockwise.
Thank you very much for having me.
How is the market? The market entirely.
the NGX, we saw the slump yesterday on the NGX. And the reason, obviously, was because of some of the developments we've seen, especially the big boys, the Fugas.
And the big boys
the Fugas slumped and the NGX slumped too.
It is a time for the big boys to cry also.
Yeah, and which is the reason why we talk about market concentration. You see, when just a few names constitute 50 to 60% of the entire market cap, it's a big problem. And we have not even seen it yet.
Okay.
Let's wait until Dangote comes in. Dangote Refinery and Petrochemicals will literally do 43% of the NGX. So Dangote, only Dangote Refinery alone can just a little bit of, like they say, when they snitch, the NGX will catch cold.
Okay.
So that's why that's one of the things I've been talking about on this channel about concentration risk. When few names occupy a dominant position in the NGX, then it becomes
once they sneeze, everybody catches.
Yes, everybody catches cold. Because if you look at if we had something like an equal weighted index, you would have seen that the equal weighted index wouldn't have slumped the way the NGX slumped.
Now, let's tie that down to what is happening in the oil stocks, and also see how we can actually bring it together with also the opening of the Strait of Hormuz. What's actually going on now? Are we seeing changes?
So yes, we see changes. We are even expecting more to happen. I mean, on Friday, the US and Iran would sign a peace deal. I know that has already been priced into the markets, but remember, we still expect to see, even Dangote has announced that prices of oil will come down. Of course, like you see that Brent is already selling at near $80 per barrel, which is the market pricing in the peace deal that is being signed, is going to be signed on Friday. So the point there is that once stability returns to the Strait of Hormuz, I think it will take about 6 months for that to happen. You know, remember, it's not going to happen instantly because there's what we call the long and variable lags when it comes to the impact. So a lot of vessels have been there for months. It's almost 4 months since we started the hostilities there. So those vessels have to go. We need to have normalization of traffic across the Strait of Hormuz before we can think of any form of rebate.
No, we've been talking about the upstream sector for a very long time. We've mentioned the big boys because one thing we do on this show is that we follow the big boys. You follow the money. If you want to make profits as far as the stock market is concerned, you go where the money is going. So we've talked about the upstream for a very long time. Now let's look at the downstream sector. How has all these events happening around the world, how is it affecting the downstream sector?
So let me talk about from certain pointers. Number one, price point.
Okay.
I mean, you've seen what has happened. A lot of people I want to speak from the demand side. A lot of people are scared of buying fuel. I mean, you can't be buying fuel at 1,300 per liter. You might want to consider other alternatives. If you're driving, you might want to take public transport. So the demand for petrol has actually reduced significantly. But what will happen when the Strait of Hormuz, when everything is settled, when you have oil going back to, let's say, between the 70s, where at least the pre-conflict levels, what you'll have is that we're looking at petrol going down to maybe 900 or 800 naira. If that happens, then more people would be able to. I mean, if you add 300 naira to what, 200 naira to what fuel is currently selling at, then you will have like 1,600, which would have bought you 2 liters pre-conflict.
Yes.
You know, so you have greater demand. Guess who that would favor the downstream players?
Okay. And the investors.
And the investors, of course. But downstream players are going to, because when you look at petroleum distribution, it's actually a margin. It's actually a volume game. The margins are not that much. It's how much volume can you? What's your distribution network, and how much volume can you do per day? So that volume also depends on the demand, and the demand also depends on price.
Okay.
When the price goes down, what happened? Just like the normal forces of demand and supply, and price, in economics. When the price goes down, more people will be able to afford fuel,
Yes.
and then that would also increase the volume that these guys have to do. And then, of course, even with a tiny margin, they can make some serious profit.
Let's point companies.
Okay.
Stocks in the downstream sector.
Yes. So my first pick will be Conoil.
Why?
Because Conoil, it has a nationwide distribution. Remember what I mentioned. The key thing is distribution.
All right.
The margins are tiny.
So distribution is the main game.
So the distribution is the main game. The more distribution you can have, the greater profit you are likely to book. Distribution, number one, stability of supply. I mean, we've seen a number of downstream players that they would show up today, tomorrow they're out because of lack of supply. When was the last time you saw queue at filling stations?
For a long time.
Gone. Now, but you have lower prices. Lower prices means more demand, and then you have a stable supplier like Dangote. What that tells you is that most of these downstream players are going to benefit. So, because that time that you have, maybe you have shortage of fuel, that time that you don't have fuel, that's money going.
Yes.
Because operational cost still remains the same, but guess what? Revenue is not coming in. That leads to what we call margin compression. Okay. So Conoil has that distribution network. It has its record. It has a.
You've always said this about me. You see, the main point of investing to me is about dividends.
Yes,
that's what I see. It's about dividends. For me, I'm many others. It's about dividends. The dividends
for me is growth.
You use growth now. Now, you've not talked about what about the dividends yield of Conoil?
So, Conoil. Let me speak from my own side.
Okay.
I'm a value investor. So I look at the Conoil is trading on 25 times earnings.
Okay.
That is trailing 12 months, 25 times earnings. That is a little bit more kind of a premium to what the industry average is. But in terms of dividend yield, Conoil to me is more of a growth story than a dividend story. I think in the dial is because the dividend yield is 0.94% really. So, but if you are chasing dividends, yes, you can have something there. But I think I lean more towards growth in itself, because at the end of the day, like I told you in the previous podcast, I really look at I do dividends, so I have a very strong dividend portfolio really. But I look at absolute, because if I what is the purpose of dividend? To give you cash flow. If I want cash flow, I can borrow against my assets. So if you look at it at the end of the day, I still for chasing growth, I still make more. Except during downturns that you will say, okay, let me go for defensives. That's understood. But when you are looking at a bull market, when you're looking at a growth story, then I think a growth environment, then you should be looking for growth stories, really. But in terms of dividend yield, that's the number, 0.94%. So you can, and I think it's around, you are looking at 2 naira 60 kobo, maybe, but again, I lean more towards dividend yield, because it's not about the earnings per share for me. It's about how much they are paying to.
Because I wanted to go there. I wanted to ask the earnings per share.
It's about how much do they pay to investors.
Okay.
If it's a growth story, most growth stories are most likely going to invest more in expansion, and rather than give so much to investors. So that's why I'm saying don't really be looking only at, what's the earnings per share? No. Don't be looking at how much are they giving to investors. No. Look at how much growth is baked into this particular story.
Earnings per share is also one of the factors you should use to actually measure growth.
Earnings is of course a factor that you use to measure growth. of course, I'm big on strong earnings growth, but because and for me, I'm big on that because the earnings is what will be what retained earnings can be channeled back into what into expansion.
Okay.
Like I told you, we are looking at if you are going to be a dominant player, especially in downstream oil and gas, then you have your distribution network has to be literally ubiquitous. You have to be present everywhere because that allows you to do more volumes. And for a tiny margin business, volumes actually matter even more than the margin itself.
So after Conoil, what will you pick again?
So there are two names. They are equally like literally similar, but I pick one that I should even put that as number two number twos.
Okay.
But I will pick one as number two because, and I have my reason for it, because in terms of distribution network and in terms of growth, sorry, I know that you are a dividend guy.
The dividend is the main thing.
But I'm
not paying dividend. I don't know what you're doing.
No. but let me speak for myself first before I go to the dividend guy.
Okay.
Eterna PLC.
Okay, Eterna PLC.
Yes, Eterna PLC is, for me, is good because it is very cheap. 13 times forward earning, 13 times trailing earnings.
Earnings, okay.
So compare that to 25 times earnings.
Okay.
This one is more almost half as cheap. Okay. So what that means is that there's a high potential for growth.
What of their business model?
I mean, they're mostly into distribution of petroleum products.
Because we have to also look at the fundamentals.
No, the fundamentals, like I told you, most of them share the same. Apart from the next name I'm going to mention, most of them share. That's why if you ask me to pick two names that will benefit directly from the reopening of the Strait of Hormuz, I would say Conoil and Eterna PLC. Because most of them actually play within the same space. So the fundamentals are literally working almost in the same way. But for me, so when I look at two companies, I know that in terms of market capitalization, this one is literally like half of Conoil. It's half of Conoil, even less than half of Conoil. So what that means is that if you with strong management and all of it, you have this one is a bigger growth story. And even the earnings, the price is cheaper. It's trading at 13 times earnings. So you see, there's a greater chance of growth. And by the way, this one, if I pull up the chart, it actually has come down very significantly.
At what point is it now?
It's literally stuck in a demand zone. So
it's a very nice time.
So it's a good time to start accumulating. It has actually come down from all the way from 50 back in March.
Okay, March 50.
Yes. All the way down to 30.
It's not really a strong pullback.
That's a very strong pullback.
From 50 to 30?
From 50 to 30. That's a very strong pullback. And it's coming to a demand zone. Now, I mean, if you look, that demand zone that it's currently sits was actually like more than 12 weeks of demand, of accumulation there. So I look at this as a retest of that accumulation zone.
So at this point, you can still...
at this point, you can literally ladder back in.
Okay.
To the position.
So you're expecting it to go to?
So I'm expecting it to kick out these all-time highs.
We're going to show this chart that people will follow.
I think we should do that.
Okay.
So I expect it to kick out this all-time high. And remember, for most of this, when you look at distribution, stability, spread, volume.
Okay.
Those are the key things you should look at.
Stability, spread, volume. Yeah.
Stability in access to products, volume you can do, and the spread of your distribution network.
All those revolve around sales.
Yes, those revolve around sales. And remember, tiny margin.
Okay.
So volume actually makes it to be profitable.
Yeah, sales is a very good indicator.
So it's very good. So those two names, Conoil and Eterna PLC, are in very good shape. There's a name I would have mentioned, but we got delisted since last year.
Which one?
I even buy fuel from them too.
Which one?
MRS.
Okay.
But they got delisted last year. They voluntarily actually delisted. So because MRS works directly with Dangote. In fact, MRS and Shafa, they work, but we are concentrating on stocks. Those are listed on the NGX. So if you look at, so those two names are very good. Very good names. I mean, like I told you, I'm a value guy. Let me now go to the dividend behemoth.
Would that be number 3?
That's number 3. The dividend behemoth with a dividend yield of 6.25.
That's a good business. That's a good business. Let's hear it, please. No, you see, once you're not paying dividends, no matter what you're doing, you're not making investors happy. That's what we see. Because we are not sure of your growth, but we are very sure of your dividends.
Do you know what some companies do? Some companies deliberately keep some retained earnings. Instead of investing, they keep it. So they can demonstrate growth. They can demonstrate dividend payment. It's one of the red flags I talked about. Imagine I make money today, but I neither give it out to investors. I give investors something, but I'm not reinvesting the other one. No,
Yeah.
I'm keeping it so that if I don't make money next year, I can pay investors.
No, that's manipulation.
Invest it.
You want to see growth.
I'm not saying sitting on free cash flow is free cash flow is good. Sitting on some liquidity is good too.
It gives you assurance.
It gives you assurance.
Yes.
But I know that it's because of the Nigeria's peculiar situation. That's why this is a theme that we are discussing. Otherwise, the normal thing is you pay out, you get whatever you make as profit, you pay investors and reinvest the other ones to expansion. Because if you don't expand, you don't make money. We are talking about this, a distribution business. Volume. It's like you can liken it to an FMCG, fast moving consumer goods. The more you're able to distribute, the more you make money.
Okay.
Sitting on cash might not, especially at the time where we expect we're expecting Dangote to list. Dangote is good, most $5 billion they're looking to raise to expand their capacity. So that means output will increase significantly. It's a modular infrastructure. So you can see from that 650,000 barrels per day, you can be looking at nudging towards 1 million. Dangote is already at this point, they're already taking more from upstream players. So there's a very high chance that they could actually push more and get to 1 million. If that kind of supply is there in terms of finished product, then you need to expand your capacity to be able to deliver this to Nigerians.
Do you think that Nigeria, this downstream, they are even ready for what is coming on?
Yes.
Are you sure they have the capacity?
No. So it's a capacity issue we're talking about now. Do you know that we are still importing products?
Yes, I am.
Finished refined products. That's what we are saying. Buying locally cuts down a lot of costs, logistics, insurance, a lot of things. So you see, if you get money, the idea is for you to do what? To prioritize expansion. But the Nigerian investors will not listen. No, they will not listen.
The peculiar nature of our investment.
No, and I experienced it myself. I talked to a few clients, and you tell, okay, so we're looking at are you looking at 10 years, 15 years investment? You say, which one? Oh God, can you work out something 1 or 2 years? But listen, 1 or 2 years is not. Let me give you something. I'm not trying to digress.
No, I think we should actually find a way to.
I'm not digressing. But watch this. I mean, everybody shouts SpaceX, millionaires. Well, do you know how many years those guys have had to stick with? Over 20 years. They have to stick with that, hoping. And now it has paid off big time. That should be a wake-up call for Nigerian investors to begin to think long-term.
No, I think we should actually structure our portfolio to actually include both stocks for dividend yield and also stocks for long-term investment.
I'm not saying, like I told you, I also have dividend. I have a blended portfolio. I have dividends. I even have mutual funds too.
Yeah.
I have treasuries too. It depends on I have a mix of all of that. But what I'm saying is that there are just 3 names, real names, when it comes to that, especially in the stock market.
Downstream.
The idea is you don't keep so much for investors when an opportunity is beckoning
for expansion.
That is how you even make more and make investors happy the more.
Yeah.
Look at Chevron. I'm sorry to jump up. Chevron's dividend payout has been increasing for the past 82 years. You know why? Because they are very big on acquisition of new fields and all of that. So the name I'm actually talking about here is TotalEnergies Marketing. So they have a dividend yield of 6.25. Their earnings ratio. So that one is for you because you are the dividend guy. So for me, I would pick if I'm to pick the top three. I will pick Conoil. I will pick Eterna PLC, and before I pick Total.
I think I'll pick Total first. If I was to pick.
Well, you are not the guest here. You are not the analyst here. Anyways, there's another name that people think is also a downstream player, which is Owando. But Owando is not. Owando is, they acquired Ajib.
Yeah.
Nigerian Ajib Oil Company.
Okay.
So they acquired that. Actually effectively makes them an upstream player. So that's why you saw when I was mentioning names when we're dealing with upstream, I mentioned Seplat, I mentioned Aradel, and I also mentioned Owando.
Yeah.
And I also bought into all three of them. Now Owando is more like an upstream player with a marketing component. That's what it is. So you can if you are investing in Owando, you are literally investing in an upstream player, really.
Okay.
So, but the names we have Conoil, we have Eterna PLC, we have Total. How would I invest if I had 100,000 naira? 50,000 cash goes to Conoil.
Because of you're a long term.
Because it is it is a behemoth here.
Okay.
In fact, for me, Total is more like a defensive play.
Okay.
Total is a defensive play for me. Then 30%, at least 30% to Eterna PLC.
Okay.
Then maybe 20% to. It can be 30% or 40% even to Eterna PLC, then 10% to TotalEnergies.
Okay. That's you. You said to structure your portfolio.
If I'm to structure your portfolio, and it happens that I'm the guest here.
Okay. All right. I agree. I agree. Now, let's look at, before we go, let's run up with something very important. I want us to tie the incoming Dangote Refinery listing to these events, to these stocks you've actually listed. How will it affect them? Let's talk about it will it take a longer period of time before we start seeing the benefits of what done? Because I know these stocks will be affected directly by Dangote listing. How long will it take before we start seeing
I believe that there will be some short-term effect. There should be longer-term effect. So investors will come in, invest in Dangote. We don't know the listing price. We have not seen the documents yet. But some people would still look at other names that they believe are cheap. They could look at downstream players.
Yeah.
We don't have many downstream players. I think it's basically these three and maybe one or two more that are listed in the Nigerian and the NGX.
Okay.
So, like I told the investors, some investors always like to invest across value chains. So they invest in the upstream. Aradel and Seplat are some of the behemoth there. Then they invest, and of course, Conoil, like we've mentioned. Then they invest in the midstream. So, and then invest in the Dangote, of course, the Dangote, which is the primary thing, and then also invest in the downstream. Okay. I expect even more listings after Dangote in terms of the downstream players, because Dangote is raising this, but they are not raising this money they are raising it to expand. Okay. And what that means is that they are going to expand the capacity. That meaning that the market will be lucrative for more, because refining, like I told you, is a tiny margin business too. And volume is just volume is there. So when you have volume, there's margin expansion. Prices could come down. The product become affordable. More Nigerians buy. That increases the margin for downstream players. So I expect both a short-term and a long-term impact. Okay. On. All right.
I think we can leave it there. You say Conoil. You've mentioned which other one again?
Eterna PLC and then made Total.
So we'll keep watching them.
But I would say something just as we wrap up. Except you want to do strictly downstream. Otherwise, if you're looking at building an oil and gas portfolio, I would want you to put one or two upstream players.
Even midstream.
Yes.
Yes.
So, but at least let's have a mix of some upstream players. Except you just want to build a downstream portfolio, that's when you can follow what we just mentioned.
All right, thank you very much. I think it's a nice place to actually leave it.
Yeah,
thank you for coming.
You're welcome.
Now, on that note, we'll come to the end of today's episode of Clockwise. Do not forget to like, subscribe, and also put on the notification bell on this channel because of the amazing content we bring. And also, do not forget that there is always a bull market somewhere, and we are here to help you find it. My name is Providence. I'll see you again.